Now with this new jobs report, there's going to be pressure to lower rates. And if you lower rates, what do? You up inflation. And I don't think we've even hit their 2% target, but we're close right now.
Yes.
So they're going to then need to move their target to 3%. So there's kind of like, what does that mean, right? If the Fed is moving its inflation target, which it hasn't done since the 70s, right?
I'm not exactly sure when, but they did talk about this, like, a couple of years ago. They talked about maybe moving the inflation target. If you guys remember, in 2022, inflation went up to 9.1, right? Like, remember? And then the Fed kind of reacted late, and they started doing these rate cuts, as you guys know where that went. So we went from really, really, really low interest rates to really high interest rates, which brought inflation down. And, now it hasn't hit 2 yet, but that has been the target up to this point. So this moving in the needle could happen. I will tell you, just before we jump past this, I think this is a really important note. 2% to 3% is 33%. Like, just wrap your head around that. That is a big difference. Now, I don't know if it's 3% is going to be the number, but the point is, they're essentially saying, if you save money, we're going to target a 3% inflation rate. So you savers are in big trouble. Anybody who has fixed income saving or anything like that, this is a big, big problem.